Okay, hello, it's the farmer here, back on the farm. Right, I've been asked by somebody in the comments to do a quick video about what a fair value gap is, because all of my strategies involve the use of fair value gaps. So I'm going to tell you what they are, and we're going to do a few examples as well. Watch till the end, because there's a bit of a strategy just looking for fair value gaps, which is profitable if you do it right. Anyway, on with the video. Okay, welcome to the chart. Right, this is a very dodgy picture, but I've drawn it a little bit earlier, trying to explain really what a fair value gap is. So if we look at this here, we will see we've got green candles up, we've got red candles down, we've got the body, which is denoted by the open, the close, and then the wicks are the candles high and low. And if we look at these up candles here, we can see price was delivered up, and price came down, sold into that, and then continued higher, and then sold down into this candle's body, and then continued higher, and then sold, bought up here, and then sold off down there, and then down there, and then bought up here, sold off down there. This is what we call efficient pricing, and it's efficient because it's evenly matched. It's, you know, it's fine. There's bias for the sellers. You can see it goes up, it comes down. That it's efficient pricing. Now, when we're looking for fair value gaps, this is inefficient pricing. So let me give you an example of what a fair value gap is. So if we had candles coming down here, candle coming down here, let's just imagine that this candle was quite a big, strong, bearish candle. Let's get this right. So it's quite a strong bearish candle, and then this one comes down here like this, but there isn't a wick on the top. Okay, so you've got price coming down, price coming down, price coming down, and you will notice within this there is an area here where there's been no buying. Sold off, sold off, sold off. We've got an inefficiency here. It's called an inefficiency. There's been a lot of selling pressure, but there's no buyers to balance the market. And this is a fair value gap. Now, the market is very efficient. It likes to fill these fair value gaps, and it will fill them. It might not fill them straight away, but it will. Price will come back, mitigate this area. It's called filling the inefficiency and making the market efficient again. And that's all a fair value gap is. You're just looking for an area of price where there is essentially no wick on this side and no wick on that side, if you want a really, really simple way of explaining it. So what we're going to do now is we're going to head to the charts, and we're just going to try and find some fair value gaps on the charts. And if we find some, we will trade them, and we'll see what happens. So let's start over here. Right, price is coming down. Price is coming down. And you can see there's a fair value gap here. There's no wick to the left, there's no wick to the right, if you want the simple explanation. So we've got a fair value gap. We could enter here for a short, close above the top, which would be sort of there, and we'd be looking, because that's the top of these, we'd be looking for a 1-to-1. So we go to 1-to-1 there, and let's have a look. Price goes down, comes back, hits the inefficiency there, and sells off. That's a winner. Let's keep looking. Okay, so we've got a big sell-off here and a big sell-off there. There is no fair value gap here. Look at this down wick there, up wick there. It's not really a fair value gap, but hey, there is one here. So let's mark this one out. Okay. Now if we look at this, this is one of those areas that I don't think's been mitigated. Oh, it is. It is. So let's look at this one. Above the high, targeting a 1-to-1. There you go. I mean, that's quite an extreme example. It would take a while for that to play out, but let's keep working our way down. So we don't have a fair value gap there. We haven't got any here, but we've got one there, look. So let's mark that out. Can you see? We've got one there. Let's take this short from here. High. Well, you could go there or there. I mean, it doesn't really matter. Let's just say we're going to go there. Let's mark that out all 1 to 1. It's a winner. We've got a fair value gap in here. As you can see, we got one there. So again, this is one that would probably lose. Looking at this, because you'd probably want to run it from that high. And then we go 1 to 1. No, it would. No, that one would. That one would work as well. And we can keep going. We can keep going. It's really that easy. Now you will get losses because, you know, you can see that you're taking these short because we've got bearish order flow. Now here you would take this one here, wouldn't you? And it would lose. Fair enough. And you will take losses. You'll always take losses. But then you look at this candle here, you can see that there is a break of market structure. So instantly, once this candle closes above this high here, you will instantly be looking for longs. So let's start looking for longs. We would enter at this fair value gap here, targeting 1 to 1. And look at that. Taps in perfectly. 1 to 1. You could enter again. Where else could you enter? You can't enter here. These are all very efficient. Now, here's another one. You could potentially enter long here. You would lose, just like I said earlier. But we have a close. Let me just get rid of that. I don't know what that's there for. We have a close here. Breaking market structure to the downside. So we'll be looking for shorts. We've got a fair value gap in. Let's draw that in properly. Fair value gap in there. You might also say, why aren't you taking this fair value gap here? Well, you could, but I like to take the ones which are at the extremities. That's just personal preference. High above the low, targeting 1 to 1. Let's see if this one plays out. Oh look, there's one that didn't play out, but it got pretty close. And you could have said, well, maybe I want to target that high instead, you know, in which case it would have. So you've got to play around with your stop loss. And that's it. That's all a fair value gap is. That get on your charts, go back through them. The market is fractal. It works on all time frames. Monthly, weekly, daily, 1 minute, 15 seconds. It works on all time frames. Get on the charts, get back, go back, have a look for fair value gaps. And just trade them, and you will be profitable. You will lose some, but you will be profitable overall by taking those trades. Also, if you use market structure shifts and things like that to get an overall bias for which way you want, you think the market's going to go, that will increase your win rate as well. Now I'm going to do a video on market structure shifts and highs and lows and things like that. Because I've been asked to do one of those as well. But I hope this has been useful. Just back test it. Anyway, I hope that's been useful. Stick a like down below, please. It helps. Pop something in the comments, if you want to me to do any more videos and things like that. Hope you've enjoyed it, and I'll catch you back on the farm next time. Bye for now.